Chapter 3-1 Adjusting Accounts for Financial Statements. Here we see two sets of financial statements for Jensen Company at the year-end, December 31st. The left column shows the balances before adjusting entries, while the right column shows the balances after adjustments. Our task is to carefully compare the two columns and determine which adjusting journal entries were recorded. There are 5 adjustments, labeled from A through E. For example, entry A reflects fees that were earned but not yet billed. It's important to note that none of these adjusting entries involve cash. They are accruals and deferrals only. Here is adjustment A. Fees earned increased from $600 to $2,000. We need to add $1,400 in revenue. The journal entry is to debit accounts receivable for $1,400 and credit fees earned for $1,400. Why should the company adjust it? Because without this entry, revenue would be understated. The company has already provided $1,400 worth of services, but since the bill hasn't been sent, it wasn't recorded. Why hasn't the bill been sent yet? Often, there's a time gap between completing the work and issuing invoices. For example, services may have been finished at year-end, but billing is done the following month. Or the company may send invoices on a monthly or quarterly schedule instead of right away. So even though no bill has been issued yet, the service is complete, which means the revenue is earned. The adjustment makes sure it's recognized in the correct period. Here's adjustment B. Depreciation expense increased from $0 to $1,200. That means we need to recognize $1,200 of depreciation for the machine. The journal entry is to debit depreciation expense for $1,200 and credit accumulated depreciation for $1,200. Why should the company adjust it? Because without this entry, expenses would be understated and the machine's book value would be overstated. The machine has been used during the year, so part of its cost must be recognized as an expense. This applies the matching principle, spreading the cost of the machine across the periods it is used. Why record it on the last day of the year? Because financial statements are prepared as of December 31st. It's not practical to record depreciation every day. Instead, the company makes one adjusting entry at year-end to capture the full year's expense, so the income statement and balance sheet both report accurate amounts. Here's adjustment C. Salaries expense increased from $700 to $900. The journal entry is to debit salaries expense for $200 and credit salaries payable for $200. Why should the company adjust it? Because these salaries have already been earned by employees but not yet paid. Without this adjustment, expenses would be understated and liabilities would be missing from the balance sheet. This entry recognizes the cost of labor in the correct period and shows what the company still owes its employees. Here's adjustment D. Insurance expense increased from $0 to $500, which means we need to recognize $500 of insurance used up during the year. The journal entry is to debit insurance expense for $500 and credit prepaid insurance for $500. Why should the company adjust it? Because the company originally paid for insurance in advance, recorded as an asset. Over time, part of that insurance coverage has expired. Without this adjustment, assets would be overstated and expenses would be understated. This entry applies the matching principle. The cost of insurance is recognized in the period when the benefit is received. Here's adjustment E. Utilities expense increased from $1,375 to $2,000. So we need to add $625 of utilities cost. The journal entry is to debit utilities expense for $625 and credit utilities payable for $625. Why should the company adjust it? Because utilities have already been used, but the bill has not yet been paid. Without this adjustment, expenses would be understated and liabilities would be missing. This ensures the expense is recorded in the same period the electricity or water was consumed, following the accrual principle, even though the payment will occur later. Here's the summary of all our adjustments for Jensen Company. On the revenue side, fees earned increased by $1,400, bringing total revenues up to $19,000. On the expense side, we added depreciation, salaries, insurance, and utilities, a total increase of $2,525. That brings total expenses up to $4,600. As a result, net profit decreased from the unadjusted $15,525 to an adjusted amount of $14,400. This shows how adjusting entries make sure revenues and expenses are stated correctly, giving us a more accurate picture of the company's performance. Now let's step back and ask, why do we need these adjustments at all? The unadjusted numbers don't tell the full story, because some revenues that were earned were not yet billed, and some expenses had been incurred, but not yet recorded. If we stopped at the unadjusted balances, revenues would be understated, expenses would be understated, and profit would be overstated. Adjusting entries correct these issues and make sure the statements follow the accrual principle. Record revenues when earned and expenses when incurred, not just when cash changes hands. That's it for Chapter 3-1. Great work. See you in the next session.